The essence of IFRS 13 Fair Value Measurement. It applies to all IFRS standards where fair value measurement is required, except share-based payment, leasing transactions, and measurements which are similar to but not the same as fair value. For example, net realizable value of inventories under IAS 2 and value in use under IAS 36. So the first definition, fair value. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This means that the transaction should be at arm's length distance. Now, fair value is a market-based measure, not an entity-specific one. Therefore, valuation techniques used to measure fair value maximize the use of relevant observable inputs and minimize the use of unobservable inputs. Inputs means information. To increase consistency and compatibility in fair value measurement and related disclosures, IFRS 13 establishes a fair value hierarchy that categorizes the inputs to valuation techniques into 3 levels. Level 1 inputs: quoted prices which are unadjusted in active markets for identical assets or liabilities that the entity can access at the measurement date. We will see the definition of active markets further in this video. Level 2 inputs: inputs other than quoted prices included in level 1 that are observable for the asset or liability either directly, that is prices, or indirectly, that is derived from prices. Examples of this include quoted prices for similar assets in active markets or for identical or similar assets in non-active markets, or use of quoted interest rates for valuation purposes. Alright, so level 3 inputs. These include unobservable inputs for the asset or liability. For example, discounting estimates of future cash flows. Please note that level 3 inputs are only used where relevant observable inputs are not available, or where the entity determines that transaction price or quoted price does not represent fair value. The term active market was used frequently in this standard, and so it is important to understand the definition of active market. Active market is a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. A fair value measurement assumes that the transaction takes place either in the principal market for the asset or liability or in the most advantageous market in the absence of a principal market. Well, what is principal market? The principal market is one with the highest volume and level of activity. And the most advantageous market is one that would maximize the amount that would be received to sell an asset or minimize the amount that would be paid to transfer a liability, taking account of both transaction and transport costs. So it must be noted that the most advantageous market is assessed after taking into account transaction costs and transport costs to the market. Fair value also takes into account transport costs but excludes transaction costs. Once the accessible markets are identified, market-based volume and activity determines the principal market. There is a presumption that the principal market is one in which an entity would normally enter into a transaction to sell the asset or transfer the liability, unless there is an evidence to the contrary. The fair value should be measured using the assumptions that market participants would use when pricing the asset or liability, assuming that market participants act in their best economic interests. For non-financial assets, the fair value measurement is the value for using the asset in its highest and best use, that is, the use that would maximize its value, or by selling it to another market participant that would use the asset in its highest and best use. The highest and best use of a non-financial asset takes into account the use that is physically possible, legally permissible, and financially feasible. The measurement of the fair value of a liability assumes that the liability remains outstanding and the market participant transferee would be required to fulfill the obligation rather than it being extinguished. The fair value of a liability also reflects the effects of non-performance risk, which includes an entity's own credit risk, that is the risk of non-payment.